Imagine a country with a GDP larger than Germany and Japan combined. Now imagine that country isn't a country at all. It has no borders, no army, and no flag. It doesn't answer to voters. It answers to a computer program named Aladdin. This is BlackRock. As of 2025, they oversee nearly $14 trillion in assets. That is not a typo. 14 trillion. They are the largest shareholder in your bank, your news station, the company that builds your car, and the company that refines the oil for that car. For years, conspiracy theorists have screamed that a secret cabal runs the world from a smoke-filled room. They were wrong. The world isn't run from a room. It's run from a server farm in Wenatchee, Washington. And the man in charge isn't a politician. He's a man named Larry Fink, who realised 40 years ago that the person who owns the risk owns the world. But right now, the mountain of money Larry built is facing a threat he can't simulate in his software. The backlash is here, and it's asking a dangerous question. What happens when one company becomes the operating system for global capitalism? To understand the monster, you have to look at the scar on its creator. It's 1986. First Boston is the hottest investment bank on the street, and Lawrence D. Fink is its golden boy. He is young, aggressive, and he has just pioneered a new financial weapon called the mortgage-backed security. He is generating millions in profits. He feels invincible. The department is a printing press for money, and the champagne is flowing. In the roaring 80s, nobody looked at the downside because the line only went up. Larry Fink was on track to become the CEO of a major bank before he hit 40. He had the corner office, the respect, and the arrogance of a man who thought he had solved the market. But markets have a way of humbling the arrogant. In a matter of weeks, rates shifted. The complex models Fink's team used failed to predict how homeowners would react to refinancing incentives. The math broke. The department lost $100 million. In 1986, that was enough to end a career. Fink went from the golden boy to the pariah of the trading floor. He was forced out. But while he was packing his box, he didn't just feel shame. He felt a revelation. The loss happened because First Boston didn't understand what they were holding. They were gambling, not investing. They understood the return, but they were blind to the risk. This is the critical pivot. Most traders who blow up an account try to win it back with bigger bets. Fink went the other way. He decided to build a business based on paranoia. He realised that Wall Street was full of cowboys, but the pension funds, the people with the real money, were desperate for a sheriff. They didn't want 50% returns. They wanted to sleep at night. He approached Blackstone with a pitch. Give me the capital to start a firm that puts risk management above profit. A firm that trusts computers more than gut instinct. They called it Blackstone Financial Management. It was boring, it was technical, and it was the seed of the most powerful empire in financial history. The marriage with Blackstone didn't last. Stephen Schwarzman, the head of Blackstone, is a deal maker. He loves the kill. Fink is an operator. He loves the process. By 1994, Fink's little bond shop was managing $23 billion and generating a massive chunk of Blackstone's profits. Fink wanted equity. He wanted to split off and let the employees own the firm. Schwarzman said no. The tension in the boardroom became toxic. Eventually, they cut a deal. Schwarzman sold the unit to PNC Bank for $240 million. In hindsight, Schwarzman calls this the worst business decision of his life. He sold what would become a $10 trillion asset manager for peanuts. Fink took his team, rebranded as BlackRock, and started scaling. But he wasn't just managing money anymore. He was building something else. Something called Aladdin. This is where the story shifts from Wall Street success to systemic dominance. Most asset managers buy Bloomberg terminals to see stock prices. Fink built his own brain. He poured millions into developing the Asset, Liability, Debt and Derivative Investment Network, Aladdin. Initially, it was just to track BlackRock's own bonds. But then a funny thing happened. Other companies, even competitors, started asking, "Can we rent your system?" They were flying blind, and BlackRock had the only radar. General Electric came calling, then huge insurers. They started uploading their entire portfolios into BlackRock's servers just to understand their own exposure. This was the masterstroke. BlackRock wasn't just a player in the market anymore. They were becoming the physics engine the market ran on. But the real test of this engine wouldn't come until the world fell apart in 2008. September 2008. The financial atmosphere is radioactive. Lehman Brothers has vaporized. AIG is teetering. The biggest banks in the world, Citi, Merrill Lynch, Morgan Stanley, are looking at their balance sheets and seeing black holes where assets used to be. They literally do not know what their own complex derivatives are worth. The US government is panicking. The Treasury Department and the Federal Reserve need to buy up the toxic waste to save the economy. But they have a problem. They don't know how to price a collateralized debt obligation made of subprime mortgages from Florida. There was only one phone number to call. The government didn't call Goldman Sachs. They were the suspects. They called Larry Fink. BlackRock was awarded massive no-bid contracts to manage the bailout vehicles like Maiden Lane. Suddenly, BlackRock consultants were walking into the ruins of Bear Stearns and AIG, sifting through the wreckage, deciding what was trash and what was treasure. How does a private company become the government's cleaner? It comes down to information asymmetry. In 2008, the banks were the sellers of these toxic assets, so the government couldn't trust them to value the goods. The government was the buyer, but they lacked the technical expertise. BlackRock sat in the middle. Because they had focused on risk management and bonds, not reckless subprime lending, they were viewed as the adults in the room. They used Aladdin to model the collapse. They took the chaotic, messy data of millions of failing mortgages and turned it into a spreadsheet the Federal Reserve could read. This moment changed everything. Before 2008, BlackRock was a large asset manager. After 2008, they were the fourth branch of government. They had clearance. They had the ear of the Treasury Secretary. They were no longer just participants in the market. They were the architects of the recovery. And they used this newfound prestige to pull off the acquisition that would hand them the world. While the world was distracted by the recession, Fink saw the future. He saw that active stock picking, guys in suspenders shouting, "Buy!" was dying. The future was passive investing, index funds, computers that automatically bought the S&P 500 without thinking. Barclays, the British bank, was in trouble. They needed cash. They owned a unit called Barclays Global Investors, BGI, which owned a brand of ETFs called iShares. Nobody realised how valuable iShares was. It was a money-printing machine. Fink approached Barclays. He didn't have the cash on hand, so he structured a deal involving stock and financing that looked risky to outsiders. He bought BGI for $13.5 billion. It is widely considered the greatest deal in financial history. With one signature, BlackRock doubled in size and took control of the plumbing of the stock market. They acquired the autopilot feature of global capital. This acquisition created the universal owner phenomenon. Here is the reality of your 401k today. You send money to your retirement account. You pick an S&P 500 fund because it's cheap and safe. That money goes to BlackRock or Vanguard. BlackRock takes that money and buys shares of Apple, Microsoft, Exxon, and Pfizer. Here is the kicker. You own the economic risk. If the stock drops, you lose money. But BlackRock owns the vote. They hold the legal authority to vote those shares at the annual shareholder meetings. Because millions of people passively invest, BlackRock effectively controls 5%, 7%, or 10% of almost every major company in America. They became the largest shareholder in the bank that fired Larry Fink. They became the largest shareholder in the airlines, the media, and Big Pharma. They didn't conquer the economy with a hostile takeover. They conquered it because we, the retail investors, gave them our proxy votes by default. We handed them the keys because we were too busy to drive. Let's pause and talk about the shadow brain. If you search for BlackRock online, you'll find videos claiming Aladdin is an AI that controls human destiny. That's science fiction. The reality is actually more concerning. Aladdin isn't Skynet. It's a massive data consolidation platform. Think of it like an operating system for money. Before Aladdin, a pension fund might have its bond data in Excel, its stock data in a terminal, and its compliance rules in a filing cabinet. Aladdin unifies this. It scans the portfolio every single day and runs Monte Carlo simulations. It asks, what happens to this portfolio if oil goes to $150? What happens if Russia invades Ukraine? What happens if inflation hits 8%? It generates a heat map of danger. It sounds responsible. It sounds necessary. But here is the problem. It's not just BlackRock using it. Imagine if every general in a war was using the exact same map, printed by the same cartographer. That is the financial system today. Aladdin is used by Vanguard, State Street, the top insurers, the biggest pension funds, and even Apple and Microsoft to manage their corporate treasuries. This creates a monoculture. In biology, if you plant only one type of banana tree and the disease hits that specific tree, the entire forest dies. In finance, if Aladdin's risk model has a blind spot, a glitch, a bad assumption, a wrong variable, that blind spot isn't just limited to BlackRock. It is replicated across tens of trillions of dollars of capital instantly. If Aladdin tells 500 distinct institutions that corporate bonds are risky today, they all sell at the same time. The tool designed to prevent risk might actually amplify it by synchronizing the behavior of the entire market. It creates a herd that runs in the same direction, trampled by its own size. Why do regulators allow this? Because they are addicted to it too. During the COVID crash of 2020, when the bond markets froze again, the Federal Reserve hired BlackRock again to manage the emergency buying program. They literally hired the firm to manage the bailout of the markets that the firm dominates. It's a revolving door that never stops spinning. Former BlackRock executives staff the Treasury. Former Treasury officials go to BlackRock. It's not a conspiracy, it's a professional ecosystem. They speak the same language, they use the same software, and for the average person, the outsider, it feels like a rigged game. Because if you aren't inside the Aladdin network, you are trading on yesterday's information. By the way, if you want to understand how these liquidity crises actually work, you need to join our private community. We dissect the plumbing of the Fed every week. Link in the description. The result is that BlackRock has become too big to fail on a scale that makes 2008 banks look like lemonade stands. If JP Morgan fails, it's a disaster. If Aladdin goes offline for 48 hours, the global financial system goes blind. We have centralized the eyes of the market into one private company. And unlike a bank, BlackRock is not regulated as a systemically important financial institution, SIFI. They fought hard against that label. Larry Fink argues, "We don't own the money, we are just an agent." He says the risk is with the clients. But when you provide the glasses through which the entire world sees value, you aren't just an agent, you are the lens. And lenses can distort reality. Which brings us to the moment Larry Fink decided to stop just watching the world and start changing it. Every January, the CEOs of the world's largest companies wait nervously for an email. It's the annual letter from Larry Fink. For years, these letters were standard corporate fluff. But around 2018, the tone changed. Fink started writing about purpose. He started writing about climate risk. He famously wrote, "Climate risk is investment risk." He told CEOs that if they didn't have a plan for a net zero carbon future, BlackRock would reconsider its position. Now remember, BlackRock can't easily sell the shares because they are in index funds. If you are in the S&P 500, BlackRock has to own you. So, since they couldn't exit, they decided to use their voice. They threatened to vote against directors who ignored climate change. To the media, this looked like responsible capitalism. Larry Fink was the good billionaire saving the planet. But to the oil industry, and to conservative America, this looked like a declaration of war. Let's explain the mechanic of this war. It's called proxy voting. At an annual shareholder meeting, you vote on things like executive pay and who sits on the board. Most shareholders never vote. But BlackRock has a massive investment stewardship team that votes on behalf of millions of passive investors. In 2021, a tiny activist hedge fund called Engine No. 1 targeted ExxonMobil. They wanted to replace Exxon board members with climate-friendly directors. Engine No. 1 only owned 0.02% of Exxon. They were gnats. But then, BlackRock threw its weight behind them. With BlackRock's support, and Vanguard and State Street, the activists won. They forced 3 new directors onto the board of the most powerful oil company on Earth, against the CEO's wishes. This was the shot heard round the boardroom. It proved that Larry Fink could decapitate the leadership of a massive industrial giant if they didn't fall in line with his vision of sustainability. This is where the narrative of shadow power solidifies. Critics asked a simple question. Who elected Larry Fink? He isn't a regulator. He isn't a congressman. He is a money manager. Yet he was effectively setting national energy policy by choking off capital to fossil fuels and forcing ESG, environmental, social and governance, mandates on corporate America. Fink argued he was doing it for long-term capital preservation. He argued that climate change would destroy value, so he was protecting investors. But the optics were terrible. He looked like a king. And in America, people don't like kings. He underestimated the political polarization of the country. He thought he was leading a consensus. Instead, he walked into a trap. By explicitly taking a moral stance, he painted a target on BlackRock's back. The reaction was kinetic. Republican governors in states like Florida, Texas, and West Virginia counterattacked. They labeled BlackRock an enemy of the state. They claimed BlackRock was boycotting their local industries, oil and gas, and using state pension money to push a woke agenda. State treasurers started pulling billions of dollars out of BlackRock funds. Florida pulled $2 billion. Texas blacklisted them. Legally, BlackRock argued they were still the world's largest investor in oil and gas, which is true because they own the index. But facts didn't matter. The narrative had shifted. Larry Fink, the genius of 2008, was now the villain of 2023. He had become the face of Davos man elitism. The pressure became so intense that in 2024, Fink publicly said he stopped using the term ESG because it had been weaponized. The company went into damage control, pivoting their language to transition investing. But the damage was done. The veil of neutrality was pierced. So, did the backlash work? Did BlackRock retreat? On the surface, yes. Their marketing is quieter, their letters are less preachy. They are launching voting choice programs, allowing institutional clients to vote their own shares, so BlackRock doesn't have to take the heat. But this is an illusion. The retreat is rhetorical, not structural. Look at the assets. Despite the political theatre, despite Florida pulling money, BlackRock's assets under management hit record highs in 2024 and 2025. Why? Because the math of the index fund is undeniable. It is still the cheapest, most efficient way to invest. The states yelling at BlackRock are finding that firing them is expensive. It costs taxpayers money to switch to smaller, less efficient managers. The gravity of the black hole is too strong to escape. This leads us to the terrifying reality of infrastructure power. We used to worry about monopolies like Standard Oil raising prices. BlackRock is different. They don't raise prices, they lower them. They make investing cheaper for everyone. That makes them harder to fight using traditional antitrust laws. They have become infrastructure, like the water pipes or the electric grid. You can hate the electric company, but you can't really unplug from it. BlackRock's Aladdin is now woven into the fabric of sovereign wealth funds in the Middle East, pension funds in Japan, and central banks in Europe. If you destroy BlackRock, you destroy the dashboard of the global economy. They have achieved the ultimate corporate victory. They have made themselves essential to the survival of the system that regulates them. Larry Fink is in his 70s. The question on Wall Street is, what happens when he goes? BlackRock is a company built in his image, obsessed with risk, deeply political, and incredibly centralized. When a founder leaves a machine this complex, cracks appear. Will the next CEO have Fink's political shielding? Or will the company be broken up? There are whispers in Washington about capping the size of index funds, about forcing a separation between the technology arm, Aladdin, and the asset management arm. It's the standard antitrust playbook. Break up the platform and the user. But BlackRock will fight this with an army of lobbyists and the argument that breaking them up will increase costs for retirees. It is the battle of the next decade. The nation-state versus the asset state. The story of BlackRock isn't about a cabal of villains. It's about the logic of efficiency taken to its absolute extreme. We wanted cheap investing, so we got index funds. We wanted safe banking, so we got Aladdin. We wanted corporations to care about the planet, so we got ESG. We got exactly what we asked for, and the price was control. We handed the keys of capitalism to a benevolent autocrat because it was convenient. But convenience is the bait on the trap. BlackRock doesn't need to conspire to rule the world. They just need to wait. Every month, billions of dollars flow automatically into their accounts from your paycheck. They are buying the world on layaway, using your money to do it. The shadow isn't going away, it's getting longer. And the next time a crisis hits and the government needs a saviour, the phone will ring in Larry Fink's office again. And this time, the price for saving the system might be owning what's left of it. So, is BlackRock the shadow government? In many ways, that gives them too little credit. Governments change every 4 years. Policies flip-flop. BlackRock is permanent. They are the constant variable in a chaotic equation. They have built a machine that eats volatility and excretes power. And remember, BlackRock isn't the only one. Vanguard and State Street are right behind them, silent and growing. Together, this triad controls the voting rights of corporate America. We have moved from industrial capitalism to managerial capitalism. The owners, you and me, are silent. The managers are loud. And until that structure changes, until the passive money wakes up, the shadow will remain the only thing that matters. But don't think for a second this story ends with BlackRock. The technology they built, the centralization of risk, it's being copied. Private equity firms like Blackstone and Apollo are building their own versions. The game is shifting from public markets to private ones, where the shadows are even darker and the regulation is non-existent. We are moving into an era where the most important transactions in the global economy happen completely outside the view of the public. If you thought BlackRock was opaque, wait until you see what's coming next in the private credit markets. That is the next bubble. That is the next collapse. And we are already digging into the files to expose it. If you want to see that investigation before the rest of the market catches on, make sure you are subscribed. The algorithm hides what it doesn't understand. We don't. I'll see you in the next deep dive.